Hey everyone, welcome back to another episode of the Integrating Investor. I am Seth Levine of the Integrating Investor. Hopefully you guys all know that. And if not, nice to meet you. Welcome back to another episode. Thanks for joining again this time. Hope you enjoyed the last two episodes that we did on, or that I did, I should say, on China. I hope it really illustrated how we can use kind of really well-grounded, and that's the key there, well-grounded principles, to analyze very complex situations such as what's going on in China. Like it's not that simple. Even if we think it is, it's really through the use of principles that we can make these complex situations simple. I am back today with Jim Brown. If you had not seen Jim's episodes already, I highly recommend checking out the last couple that he did with us. You could find them on the YouTube channel there, or you could find them on my website on the media site, or just Google it or use your favorite search engine. And as always, please like and share this episode. Really helps us get the word out. You could also follow me on Twitter, Instagram, check out the website, sign up to get the monthly emails so you get the articles right in your inbox. And as always, please, use that super chat function. It's a great way to get our attention. We love trying to go back and forth here with you. And of course, all the proceeds help out the good folk at the Ayn Rand Center. And as always, any suggestions for show topics or guests, please email me at info@integratinginvestor.com. That's info@integratinginvestor.com. So as always, moving right along here, the best part is moving right along here. The episode, the disclaimer is moving right along here. The episode, the disclaimer is moving right along here. The episode, the disclaimer is moving right along here. The episode, the disclaimer is moving right along. Do your own work if you're going to invest, and good luck, of course. So as I mentioned, we are back with Jim Brown. Jim is going to continue sharing his views of money and banking. And today, I think he's going to kind of apply them to the housing market and show how his views kind of can be applied there. So with that, without any further ado, kick the show over to Jim. Jim, welcome back on the Integrating Investor.
Thank you. Thank you very much. And hello, everybody. Today, I thought it'd be kind of fun to talk about the question that you probably hear. It seems to be on every pundit's lips. Inflation, is it transitory or persistent? They used to say transitory or permanent, but nothing's permanent. So I'm going to say persistent. And who knows what persistent means, just longer than just a few months, let's say. It's interesting. The Fed has claimed, first they claimed there was no inflation, and then they claimed that, inflation will be transitory. And then that didn't work out. It went on a little longer than they thought. The CPI the Consumer Price Index was elevated a bit more. And so they said, it'll be transitory for a period of time, which is sounding a lot more like persistent to me. But that's Fed speak. They always graduate their speech to try to obfuscate their mistakes. So, what I thought would be fun to do is look at the CPI data. And this is not going to be heavy math, so don't get scared. But let's look at some consumer price index and some housing data. And what I think it can show is that the way that housing prices, actually what the Bureau of Labor Statistics calls shelter prices, the way they're incorporated into the Consumer Price Index virtually assures that you will have more than just transitory inflation. So it's just kind of baked into the cake. And the point of this is, if you're just using the Consumer Price Index to evaluate what your price index, what your cost of living is going to look like, that's probably not a good idea, because it's not meant for you. It's meant for for the Fed. And frankly, it's, in my opinion, it's meant to make things look better than they really are. Okay, so with that, let's look at the cost of a median house price and see what's happened to it in the last year. And Seth, if you have that slide, I need to get better at this so I can share my own stuff, but there we go, good. So this information comes from the Federal Reserve. And what you see there is that the little gray vertical line there is the recession caused by the pandemic. That's the pandemic recession. And you can see that just in the last year, September 20, December 21, September 21, the median home price is up almost 21%. And that is the price of a house, of course. But if we're looking at to compare that to what's in the consumer price index, we need to put that on a monthly basis because practically no one just plumps down cash for a house. They pay for it on a monthly basis. So let's look at the cost. I did a little table here, the cost of owning a home. And what's happened is not only has the price of owning a home gone up, but of course, with that, the cost of your down payment goes up. And in the interim, the cost of the mortgage rates went up just a little bit. And the net effect of all that, and this little example I took off the Zillow.com mortgage calculator, is that a median home price that went up 21% results in a monthly payment that's up even a little bit more than that, 22%. So that is baked right into your cost of living. If you want to, if you're not a homeowner yet and you want to buy a house and join the ranks of the 80 million homeowners in the USA, or if you want to sell your house and buy a new house, you may not have the financial wherewithal to do it because that is a big price increase, especially when we compare it to what the consumer price index is telling us. So let's look at the consumer price index. This next, that is a graph that I took right off the Bureau of Labor Statistics data. And you can see that the CPI, the measured cost of living, is up 6.2% over the last year. That's, I believe this, yeah, this is October 2020 to October 2021, up 6.2%. And that itself is the largest year-over-year increase since 1990. So that is quite alarming to people, but to a lot of people. I mean, that's a big move. And yet, that I contend that pretty significantly understates the cost of living. And now let's kind of go into why. Any questions come to your mind so far, Seth? I don't want to drone on here like a boring old, mule.
Yeah, no, this is good. That's great context. In the chat so far, we have MA with another super chat donation. Thank you, MA, as always. Appreciate it. But other than that, yeah, I think this is a pretty fascinating topic. It's very topical in terms of what's going on with inflation. I mean, what we're seeing in the housing market as well, and how interest rates play into all this. And I have some things to add, but I think I'll wait till the end and just kind of let you keep going.
Okay, well, the next key point is that the CPI does attempt to incorporate the cost of shelter, the cost of housing, but they do not use home prices to do it, or the kind of calculation I just did to do it. So the consumer price index measures things like the cost of food, cost of housing, the cost of fuel, clothing, utilities, and so forth. And each of those things is weighted within the index in a certain way. And the cost of shelter is by far the largest weight in the consumer price index. It's almost 33%, about 32.6% in total, the cost of shelter. Now, in that cost of shelter is both a direct measurement of rent. They ask people, how much are you paying in rent? But for the homeowners, here's how they calculate the cost. They use and this is most of that shelter component. They use a system of surveys where they call people up and say, if you were renting your house today, how much do you think it would rent for? And the resulting number is called owner's equivalent rent, OER. Now just think about that for a minute. They're literally calling people up who are not renting their homes, and they're asking them, what would your home rent for? And I submit to you that most of these people have no idea. And if they do have some idea, it's old, historical, outdated data, because many people have been in their homes a while. So this is a highly inaccurate number. And moreover, these numbers that are surveyed each month are averaged over the preceding 6 months. So the number that you see in the CPI is actually the average of these surveys for the previous 6 months, thus ensuring that older data dominates the current index number. And in a rapidly rising market with rapidly rising rents or rapidly rising housing prices, this will certainly understate the current cost if you're buying a house or if you're renting. Now, it is true that for the average house out there, your cost, your monthly cost didn't go up just because a new home price went up. Home prices, 10% of the housing market turns over every year. Similarly with apartment rents. You do independent research, and these apartment rents over the last year, the same period, are up 18 and 19%. But what in the CPI, that number is for apartment rents, the current CPI, it says up 2.7. For owner's equivalent rent, up 3.5. These are, if you're making, the point is, if you're making a decision, or if you are moving, or if you are waiting for your apartment lease to come up and be renewed, you're not going to be caught up in this immediately, but it's going to affect you pretty soon. So is that fairly clear how that works? So there's two things. Two things going on here. The estimate of housing costs, of shelter costs, is systematically low, systematically underestimated by the way the survey is done. And secondly, in a rising market, the lag in the data ensures that the current number that you're given reflects past data. So I guess the big thing is, if you are planning on purchasing a home, or if you are planning on, if you think you're going to be moving, and even if you're not moving, if your if your lease is going to be coming up in the next few years, don't use the CPI data, these benign 3.5%, numbers that they put in the housing shelter section to estimate your cost of living. Now, this is a dominant number, the shelter number that the BLS comes up with. Like I say, it's fully 1/3 of the CPI. So just think about that. If you if you assume that number is really more like 20%, talking about the cost of shelter, if that's going up at 20%, and now you multiply that times the 33 or so percent that it includes, that it accounts for the index, you're talking about roughly 30% times 20%. You're talking about over 6% cost of living increase effect on the entire CPI just from housing alone. So if you add another 4 or 5% from the rest of the items, the non-housing items, you could be looking at a pretty prolonged period of maybe low double-digit inflation. You could be looking at 9, 10, 11% inflation 6 months or a year from now. Now, I am not making that prediction, and I'm not. I don't have a lot of certainty about that at all. But I'm saying that is well within the realm of possibility. Do not be surprised if 8 months or a year from now, they're talking about CPI inflation of much higher numbers. Now, I don't know what it'll settle out to. Maybe you can still call that transitory, but it's going to be, in my opinion, it's going to be disruptive. And you were going to hear a lot about it on the news. And I guess the big point is it's virtually, because of these housing numbers, I believe virtually baked into the CPI numbers that you're going to be hearing about for the next 6 to 8 months.
Yeah, it's pretty interesting just the way kind of the math works. And that's why I think you had so many I think that's why you have so much of this. The dialogue is so heated in terms of whether or not it's transitory or not. I think it's a fascinating conversation. I've written on this and I've actually spoken on it, and it's not my intent to really get really dive into it too much on this episode. If you guys want to check that out, I have a couple episodes on inflation, because my view is that it's transitory, but my use of that word is very specific, and by transitory, maybe persistent is better, is a better way of saying it, and persistent rather than permanent, right? That's where I draw the distinction. But again, yeah, it's a really interesting point, and the way how inflation, at least to the extent that inflation, the way, first when we say inflation today, we're basically saying something akin to the CPI. So just the way how that works, yeah, like I think the analysis is spot on, Jim, where it's going to be here for a while, just by nature of by nature of the calculation, irrespective of what's going on in the economy, which is actually a different point altogether.
Yeah. So I'm going to pull a drink here just for a second, if I may.
Sure.
I am quite sure I'm the oldest person on this call, and I'm easily older. Not that that's a good thing, either way.
Yeah.
But I remember the 70s and the double-digit inflation of the 70s and early 80s very well. I had not yet started my professional financial career, but I was a grown person. I was an aware young man, not so young even. And what I'm seeing today, frankly, is that a lot of the pundits, a lot of the talking heads have never seen a nation under an economy under, noticeable consumer price inflation. And they are downplaying. I believe I see them downplaying it consistently. I was listening to an MSNBC pundit the other day. Oh yeah, the dirty little truth is, she said, we can all afford this. This is not so bad. And it reminded me of President Jimmy Carter, who tried to downplay inflation big time back in when he was president back in the early 70s and through the mid 70s. So I found on Twitter a hilarious little send up from Dan Aykroyd on Saturday Night Live from that time. And if we can play it and if it can be heard, I would love to share it with you.
Yeah,
because
this
it cracks
right there. So hopefully everyone can enjoy this as well. So here you go.
Inflation is our friend. For example, consider this. In the year 2000, if current trends continue, the average blue-collar annual wage in this country will be $568,000. Think what this inflated world of the future will mean. Most Americans will be millionaires. Everyone will feel like a big shot. Wouldn't you like to own a $4,000 suit and smoke a $75 cigar, drive a $600,000 car? I know I would. But what about people on fixed incomes? They have always been the true victims of inflation. That's why I will present to Congress the Inflation Maintenance Program, whereby the U.S. Treasury will make up any inflation-caused losses through direct tax rebates to the public in cash. Now, you may say, won't that cost a lot of money? Won't that increase the deficit? Sure it will. But so what? We'll just print more money. We have the papers, we have the mints. I can just call up the Bureau of Engraving and say, "Hi, this is Jimmer. Roll off some of them 20s. Print up a couple of thousand sheets of those century notes. Sure, the glut of dollars will cause even more inflation, but who cares? Everybody will be a millionaire."
Very, yeah. It's pretty funny. And it's really, it's a fascinating, I mean, it's a really fascinating topic. And because we're kind of talking about home prices here, you know, I was fumbling around for this and I apologize, but I've kind of looked at this analysis and, you know, the role that interest rates play in home price appreciation to me is, I think, something that I think everyone knows, but, you know, just really, you know, it gets downplayed so much. And, you know, I'd done this analysis a while ago, but so I was fumbling around and trying to bring it up again recently. But the impact of interest rates have just had such a dramatic, in my view, role on the price of homes. And we'll just leave it there because that's what we're talking about today. And I thought I'd share just a little bit of that with you right now. So if in case you don't know, interest rates, you know, basically peaked in the, I think in the early 80s, very early 80s, and have been just coming down ever since. I probably should have brought up a chart of that, but I think it should be fairly familiar. Now, I looked back some time ago, and you know, I was looked at, say, what was like the average? Where did kind of the average mortgage rate peak? And what I found is it was about 13% or so. So I said, all right, like, let's say, what would a mortgage look like at 13%? So I'll share something right here. So if you look at, this is just right off of Google right there. You know, you have a loan amount of $200,000, 30-year fixed mortgage. If you paid a 13% mortgage rate, your monthly payment was $2,200. Like that's a pretty high monthly payment rate. Now we know that interest rates have fallen dramatically from there, and you know, you could get a mortgage. You know, you used to be able to get a mortgage around 3% or so. So let's see what's happened to this loan amount, right? The amount that you could borrow as we change the interest rate from 13% down to 3%. No surprise, that $2,200 payment gets dramatically cut down to $843 a month. So what that means is, you know, you could afford more house today. So let's say you had $2,200 in 1980 and $2,200 now to spend on a house. Let's just say, you know, uninflation adjusted, right? So you had $2,200 back in at 13%. That means that you could afford to take out a $200,000 mortgage and you're paying $2,200 a month. Well, today at 3%, let's say, we could see that you could afford way more than a $200,000 mortgage. You know, you can actually afford something like a, you know, $540,000 mortgage, right? Your mortgage can go up by 2.5%, and you'll still have the same monthly payment. So anyone who's bought a home, I'm sure you can sympathize that when you buy a home, you know, you kind of back into the price that you're looking to pay. You say, all right, how much house can I afford, right? And that inevitably comes down to, what's my monthly payment? So we can see that, you know, as interest rates have fallen precipitously over the years, you know, in my view, that's been one of the biggest drivers to home price appreciation that I think we've seen since the 80s. And what's interesting is that it's pretty generational, right? That was about, you know, not to date myself, but you know, my parents were buying their first home, you know, right around that time, and now, you know, that's moved on a generation. And though I think there's I think that is a reason why we see so much psychological. Buying a home is so psychological, and buying a home is also something that people view as a way for building wealth. It's because it it wasn't necessarily a good investment from an appreciation perspective. You know, while it wasn't necessarily like an investment thesis per se, but I think a lot of the home price appreciation that we've seen over the past 40 years has been largely driven, not all, but largely driven by that fall in interest rate, and by extension the fall in mortgage rate. So a little bit of a tangent there. So sorry, we just got some super chat folk come in. Sorry to cut you off again, Jim, but we got Jonathan. Thank you again for your super chat donation. Couple super chat donations. Thank you for your $4.99 and your $2.99. MA, thank you again for your donation of $4 and your earlier donation. MA asks or states the 70s were awful. I took a second job working the graveyard Friday and Saturday night shift at a restaurant. The whole concept of inflation being beneficial really, in my view, is just an absurdity of academia and an obsession of prices over profits. And that's, again, a whole huge can of worms. Anyone who's produced anything realizes that it's not the price you pay, it's a profit that you receive, or the price you get. It's a profit that you receive that really is driving all of your business decisions, because that is your return on capital, and that is actually represents the value that you've created in excess of the cost that it took you to do so. So
yeah, if that was MA, who's also been, that was not even a hyperinflation. That was a bad inflation that involved a ridiculous term called stagflation, which I think almost has to go with that kind of inflation, especially in this country. Perhaps that's where we're headed again. Again, not a prediction, but okay, maybe just to summarize here, it's probably about time to sign off, isn't it? Seth,
yeah.
Near the end here, I need to get better at this. Watch my clock. So would you mind showing that last slide? It's of M2 money supply, broad money supply.
Yep, there you go.
Okay, so you might notice that looks a lot like the slide we showed earlier of house prices. This is broad money supply, all of it created in the banking system, most of it created because and due to the stimulus, the pandemic stimulus, unprecedented. And I would argue that this is behind, I would argue strongly, this is behind the increase in the consumer price index as well. And so in my mind, this is largely the culprit, and to be continued on further discussions.
Yeah, that's a great way to end. So, I mean, just maybe to summarize, I mean, how home prices are such a home prices that only go up are really a big driver of the great financial crisis and all the underlying things that occurred there. I've spoke about it a couple times in a few places, but for sure that whole thinking, in my view, was a big part driven by the secular fall in interest rates, as I just highlighted. Again, as interest rates fall, your home price had to go up, and interest rates fell pretty dramatically from the 80s and pretty steadily from the 80s down until the great financial crisis, and since then. And there's so many other, there are other factors as well that I think that fed into other factors, regulatory factors within the shadow banking system, but just the complexity that goes into this meme of home prices never go down, and that feeds into buying home prices. It's just one piece of this pie of like this very complicated, very for lack of a better word, very unfree, right? It's a very controlled and contrived markets with a lot of perverse incentives in play. And it's a fascinating topic. And if anything, it is definitely not a laissez-faire market by any stretch of the imagination. So I'm sure, there's a lot that can be said for it, or on it, I should say. So with that, thank you. We'll wrap up today's show. Thank you. Thank you everyone for joining. I hope you enjoyed it, and you could see kind of how this, how home prices is really an extension of money and banking that we've been talking about for, a good amount of time here on this channel. I hope it makes sense. And I hope you enjoyed. And, Jim, again, if you want to tell people where they can follow you, that'd be great.
Oh, thank you. Well, first of all, thank you for having me on again. And if you'll have me, I'll be back after the Thanksgiving break. Like most of you, I think you're going to probably take next week off. But you can find me. I don't do much on Twitter, so you don't need to find me on Twitter. But I'm at Hard Money Jim. But I do write a Substack piece. I've got another piece coming out this afternoon. It'll be a lot of what we talked about today, but in a clear expository manner rather than me trying to be extemporaneous. And it's just called Hard Money Jim on Substack, and you can find it and subscribe if you would like. I write about one piece a month and on topics like this.
Yeah, well, great. Well, thanks. Thanks for sharing. Thanks for sharing, what you found in writing and, with us on the channel here. Thank you, MA, and thank you, Jonathan, as always, for your support of the show. Can't tell you how appreciative we are. I mean, it is Thanksgiving. It is a time to be thankful. I'm so thankful for everyone here. Thanks, MA and Jonathan for your super chat donations. Everyone else who's donated on this super chat. Ayn Rand Center for hosting this. Jim for co-hosting with me. Like Jim mentioned, there won't be a show next week, but we will be back the week after, and hopefully we see you all there. For anyone celebrating Thanksgiving, I hope you have a great holiday. Anyone not celebrating Thanksgiving, I don't know, man. It's a good one.
You're missing out. You're missing out. Happy
Absolutely.
Thanksgiving, everyone.
Take care, everyone.
Bye.